You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp, the program where we explain to you all of the intricacies of the world of options, break them down to you in some very basic terms, and explain how you can use these products in your own portfolio. My name is Mark Longo from the OptionsInsider.com, as well as from the Options Insider Radio Network, upon which many of you are listening to this fine program right now. If you haven't had a chance to do so yet, listeners, I encourage you to explore the other fine programming we have on the old network, including, if you like this program, you're going to like our Options Playbook radio program that we do with our friends over there at Trade King. Mr. Brian Overby sits down every week and takes a nice, quick 15 or so minute look at a different strategy, breaks it down in some interesting terminology you might like, including some fun sports metaphors, offensive, defensive plays, all that fun stuff. Check it out if you like. This program comes out every week. Available wherever the Options Insider Radio Network programming is available, including iTunes, Stitcher, AHA Mobile, TuneIn, theoptionsinsider.com, all of our partners' websites, of course, and our mobile app available for iOS, Android, and Fire OS. You can instantly stream all of your favorite episodes of Options Bootcamp wherever you have a signal on your device. And if you don't have a signal or you're going somewhere where you don't, by all means, download them through the app for some offline listening after the fact. And while you're listening to the show, you say, you know what? I really disagree with that Passarelli guy. Well, let us know. Hit that comment, hit that tab, hit that email button there, that tab in the app, and you can shoot us a question, an email, a Twitter question, a Facebook question. You can even leave us a voicemail, all directly through the app. It's really cool. Check it out. The Options Insider Radio Network mobile app, available for your devices of choice. All right, and joining me on the old program today, the aforementioned and much maligned Mr. Dan Passarelli, the founder of Market Taker Mentoring and the author of many seminal options tomes, including my own personal favorite, Trading Options Greeks. Mr. Passarelli, welcome back to the program, sir.
Well, darn it, Mark, it's always good to be back on this program.
I like it. It's been too long since we've camped some boots, so I'm excited to get back into it. I got my whistle. I got my fancy drill instructor hat. I'm ready to roll. How about you, sir?
I brought my tents and my fishing poles.
Oh, well, that's for the after camp session. That'll be later on. We'll discuss that later. But for now, it's time to do some boot camping. So without further ado, let's dive right on into our mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call segment. This is, of course, the portion of the show where you guys get your chance to sound off and join us on the old drill instructor squad, make your questions or comments known to us. As I said earlier, no shortage of ways for you guys to do that. Shoot us an email, shoot us a question via Twitter, leave us a comment on the optionsinsider.com, or you can even leave us a voicemail. And most of those you can even do directly through our mobile app. So no shortage of ways for you guys to get in touch with us. And we thought as we were planning for this show, one of the reasons I enjoy doing the show, and I'm sure Dan as well, is that we get the chance to really interact with you guys on a regular basis, see what you guys want to know about, hear the questions you have about options, and that's a great thing for us. It gives us a lot of great feedback, a lot of great insight into what you guys really want to know and what you guys want to hear about. So we thought, what better way to shape the show today than let you guys do it. So we're going to hit on some topics that you guys have written in about. Starting off with a question coming in here from Jason Kruse. He writes, is there a bootcamp episode that discusses open interest and how it can affect expiration moves? I hear people talk about max pain and pinning like it's a conspiracy. I would love to hear real info about how it works. Well, it seems like, Dan, I don't know, but it seems like everyone has got open interest on the brain these days. A lot of people writing in to a variety of shows on the network with questions about open interest. Jason's just one of them, and he, of course, taking the tinfoil hat route here about conspiracy and open interest. And to answer the beginning of your question there, Jason, no, there really isn't an episode that we've devoted to that, so I thought, why not do that now here on this program and take a deep dive into open interest a little bit and explain and maybe dissuade you of some of those notions you may have about it. So, Dan, why don't we start there? Let's start off with a nice basic overview of open interest, and we'll get into some of the more esoteric tinfoil hat type suggestions that Jason has for us.
Sure. Open interest and volume are a couple really important fundamental options metrics. Problem is they're very often misused, and very often traders look at them only superficially and they think they're gathering market data, but really they're just going down a rabbit hole and they're trading on not enough information. They use it sometimes just enough to be dangerous. So open interest, well, let's start with volume. That one's a little more intellectually friendly, I guess. Volume is pretty simple. It's the number of contracts traded in a day. So maybe, we're talking about Facebook options. I was looking at Facebook earlier today. I think there's, was that Facebook? One of the out of the money puts in the front expiration traded like 10,000 contracts today. So, you look at that and it's simple. It's just a number of contracts that were traded. And of course, you kind of have to really think about the mechanics of what a trade really is when you think about this. It makes it a little easier to digest this information. A trade is, of course, one buyer and one seller. So, maybe Mark sells me a put. I buy the put, I own it, now I'm long one. Mark is short the put. He sold it to me, he is short it now. So that's one contract that was traded. Okay, now when it comes to options, they're different than stocks. Like when a stock is first born into existence, it's done so through an initial public offering or a secondary offering or what have you. But like on the day of the offering, there are X number of shares that now exist and somebody owns them. With options, it's very, very different. With options, when an option contract first starts, like remember when Twitter first started trading, how long ago was that now? A year or whatever it was, I don't know. The first day Twitter started trading, there were no options, but a buyer and a seller, like me buying a put from Mark, would create an options contract. Maybe I'm buying a 1 lot from Mark. Maybe I'm buying a 100 lot from Mark. Either way, when we consummate that trade and I buy and he sells and we make that trade, we're creating an options contract. That's called open interest. Open interest is the number of contracts that have been created. Now, maybe 2 weeks from now, the put I bought from Mark, probably if I bought the put and Mark sold the put, probably the stock would go down and I'd make money and Mark would lose money. So maybe then I decide that I'm going to take my profits and Mark decides he's going to take his loss. Well, then maybe I sell these back to Mark and now those contracts don't exist anymore. I closed that position and Mark closed that position. So open interest grows and shrinks as contracts are opened and closed. And it's a running total where volume resets every morning and it starts at 0 every morning. Open interest is a running total and it's updated in the morning. It shows all the interest that was opened or closed from the day before, and it's a running total.
All right. It's amazing how simple on the surface open interest really seems, and yet once you start digging into it, how confusing it becomes. And we had this debate actually on our option block program a week or two ago that so many professionals in the option space still confuse open interest to this day. I just did a cursory search before this program to kind of see what the internet tells people about open interest, what perception they're getting from doing the old Google foo on open interest. And even there, it's, as you might expect, Dan, it is a array But at the end of the day, it's a very confusing process to what actually the calculation for open interest is. They go by exchange. And then, of course, a lot of people get confused by market makers because market makers taking the other side of that. And, of course, that's true. So they net out market makers and they do this whole big convoluted thing. At the end of the day, that's their number that they print out for open interest. And so Dan's point is good. People get confused quite often. Volume and open interest are not the same thing. You could have 10,000 contracts going up on a strike that also has 10,000 contracts open, and those could be closing. So the very next day, there could be zero open interest on that strike because they came in and closed out all those contracts. So open interest and volume, not the same thing. You need volume, of course, to create open interest. But at the end of the day, the open interest is a netting process. And so that's why the volume is not exactly the same thing. Remember, when you go into your brokerage account, listeners, for options, they usually ask you, are you buying to open? Are you buying to close? Are you selling to open? Are you selling to close? That's one of the things that goes into that equation so they can track and analyze and get you those trades executed effectively. So that's important. It's not the same thing as open interest. The other thing people really should keep in mind when they're looking at open interest is that open interest is calculated on a daily basis. It's not a real-time indicator. A lot of people like to look at open interest and say, oh, I want to keep track on this on a regular basis, but you can't. It's once a day. They come out with, here's the numbers, how they changed for the day before, and that's it till the next day. So if you're into real-time data, real-time analytics, all that sort of fun stuff, open interest is not going to do it for you. It's not going to be that useful. And so that's why I kind of get back to when people really fixate on open interest, it's useful, don't get me wrong, but you need to keep in mind the limitations of this thing. So, for example, a lot of people like to look at open interest as an example of some activity on a strike. And it's a good thing to pay attention to this, particularly if you're looking at some names that are perhaps a little bit less liquid. Or even if you get to some farther out months in an active name, usually a lot of activity in a liquid name is going to be in front month at the money strikes. Once you get beyond that second, third, fourth, fifth month, or even a year or more out, you start to lose some of that liquidity. So it's important when you're putting on a trade to keep in mind and look at the open interest on the various strikes. That will give you some indication of what has gone on there prior to your trade, and it'll give you some indication of how easy it may be to get in and out of that trade. The other thing that will show you that, of course, is the spread of the option, which is, again, why I say open interest isn't critically important, because at the end of the day, all of the salient details of open interest should be reflected in the option spread. So you'll see it instantly. If you go to an option and you realize it's really, really wide, you don't need open interest to tell you that it's not very liquid. And the same thing, where if it's really tight, you don't need an open interest to tell you, hey, there's a lot of activity going on here. So open interest, but is useful in that equation when you're looking at a name, you're looking at certain strikes. It'll tell you there's a lot open on this strike, so someone will probably be coming in down the road to perhaps close this, and it'll give you an indication of some future volume you may want to pay attention to. The other thing he mentions here, max pain and pinning, that gets to a topic called pin risk. We've addressed it a little bit on the show in the past, but it's been a while, so it's worth bringing up again. This is the notion of right around expiration when we see an underlying vacillating, a stock usually, and then all of a sudden it closes exactly at a particular strike. Now, why is that called pin risk? Why is that a risk at all? Well, if you think about it, listeners, this particularly comes into play when you're short options going into expiration. Again, this is why Dan and I always counsel that you should close out any short positions you may have that are hovering right around the at-the-money strike that have any reasonable probability of being exercised or assigned against you. For this exact scenario, you close exactly at the strike. Well, now, what do? You're short contracts on that strike. You'd have no idea what's going to happen to you come that following Monday morning. There's no automatic exercise threshold being triggered because you're at that strike. And now, so the question you have to ask yourself is, well, gee, do I think people are going to assign these against me? Do I think they won't? You have to do that kind of guesswork in your head. And typically what people end up doing is they probably hedge half of that position because they don't want to come in on that following Monday, let's say, short a bunch of shares of an underlying that they weren't particularly planning on shorting that day. So maybe they buy some shares to hedge against that in the after hours market just in case. But again, that's a risk because you have no idea what's going to happen with that position. So that's what pin risk is. It's when you close right at that strike and you really have no idea what's going to happen to your positions the following Monday as a result. So that's why it's a risk. Open interest helps with that because there is a prevailing theory, and he makes it sound like it's some sort of, behind the scenes thing, but there is some net fundamentals to it that right around the close on expiration Friday for a lot of names, the underlying is going to gravitate towards some strikes that have a high degree of open interest. And there certainly is some truth to that. Those strikes tend to act as some sort of magnet. So if the underlying is kind of vacillating around and is getting near a strike that has maybe thousands of contracts open interest and it's getting towards the close, you're going to see maybe some of the hedging activity from some of the market makers and others who have large gamma positions on that strike. Remember, gamma increases nearly exponentially as you get closer to expiration. The hedging activity of the gamma scalping, buying stock below, selling stock above, etc., is going to keep the underlying close to, if not pinned, toward that strike. And so that's where open interest really comes into play in terms of the expiration stuff. Is there some sort of conspiracy about it? Not really. And I think even to a degree, the impact of open interest in those scenarios can be a bit overblown. Dan, I'd be curious to get your input on that as well. So at the end of the day, it does have impact around expiration Friday, but I wouldn't say it's dramatic enough to be particularly concerned about. Again, if you're trading options properly, if you're closing out your shorts that are anywhere close to the at-the-money strike on expiration Friday, this won't be an issue for you either way. The real way we use open interest at the Options Insider, we obviously do a lot of unusual activity analysis. So in that scenario, open interest is very helpful to help determine the intent of the trader at the end of the day. If you look at a big trade going up on a strike and you say, this is interesting, I wonder if it's opening or closing, then you look at the open interest on that strike and it's exactly equal to the amount going up. You can reasonably intuit that that's probably a closing trade. And that's a much different scenario than if someone was coming in and opening that. The intent is much different. They're taking a trade off rather than putting one on. So that's where it's mostly useful for us, and I think for a lot of options traders. Dan, anything else you want to say on open interest? In particular, your views on how it impacts underlying fluctuations around expiration time.
Yeah, I mean, I would say, I think the original question was, is it a conspiracy theory? I think there's some, I won't say conspiracy theory, but there's kind of some bad information, I think, due to a lack of really understanding pin risk and why pin risk exists. Particularly this idea of the max pain theory. The max pain theory is pure conspiracy theory created apparently by people who don't really understand pin risk and why it exists. Max pain, I read on a website once, is defined as that the stock tends to gravitate to the strike where the market makers experience the most pain. Well, I mean, that implies there's like some options god or demon, if you will, like magically moving the price because that's what makes market makers lose money or something. Like, it doesn't really make any sense as it's defined. So don't consider max pain. That it's something that doesn't exist and is very amateurish. However, as Mark was describing open interest and this idea of gravitating to the strikes, there's something to that. You know, like the concept behind max pain is rooted somewhat in reality. It just sort of got bastardized along the way. And I've even seen professors mess this up. I read an article, or a paper rather, by a professor from the University of Illinois, a pretty respected school, who said, well, statistically, he did a study, and statistically, the market settled at a strike price, like got pinned to a strike price, statistically much more than it should. So of course, his assertion was, well, there must be market manipulation. Well, that's silly. Like he understood enough to do the study, but he didn't have the background information to explain rationally why. Here's why. I'll just tell you. Market makers trade delta neutral. They gamma scalp. So market makers are either short options where they're short gamma and movement hurts them, or they're long options where movement helps them. But when they're long options, they have time decay associated with those options. So what happens is the whole game that market makers play called gamma scalping, when the stock goes down, market makers get short deltas because of gamma, because of positive gamma. So they buy stock. And then when the market goes back up, then they get long deltas because of positive gamma, and they short stock. So they're always buying low and selling high and scalping their gamma, but they need to cover enough by gamma scalping to cover what they're paying in time decay. So, you know, just because they're making money by scalping the gamma, they're paying money by losing it on time decay. So it's a balance. Hopefully they get enough movement to cover the time decay. Now, on expiration day, that's when the rubber really hits the road, because, you know, if we're talking about calls, if the stock is even a penny below the strike, the calls are out of the money and the market makers should have zero stock on to hedge those calls. But if the stock is a penny above the strike, then those calls will become an exercise and will become stock. And so they have to have 1-to-1, 100 shares for every one call, 100 shares short for every one call they're long. So, you know, market makers could accumulate big positions. I mean, you know, there's sometimes if I had on 200 calls that were at the money, which is still not a gigantic position, I would have to, like, if the stock ticked down a couple pennies, I'd have to buy 20,000 shares of stock. And if the stock ticked up a couple pennies, I'd have to short 20,000 shares of stock. And so would all the traders down in the pit standing next to me. So, I mean, the stock ticks down a little bit, and, all us market makers are buying 100,000 shares, ticks up a couple pennies, and we're all shorting 100,000 shares. You know what that does? When we buy the stock, it pushes it up. When we sell the stock, it pushes it down. Now, this is not manipulation. This is us trying to not lose money. Like, we're not trying to, necessarily make money. We're trying to not lose money by time decay. And we're trying to not be in a situation where we're mishedged. We're just basically being responsible traders. There's nothing manipulative about it. There's no magical max pain or anything about it. We're just scalping our gamma, and the nature of supply and demand is taking its effect on the market. So that's why there's a statistically more likely chance of a stock being at a strike price at expiration, because the market makers are long gamma and they're just buying when it's below the strike, selling when it's above the strike, so they stay hedged. So no magic. Max pain theory is silly. The assertion of manipulation is ridiculous and borderline libelous. So that's it. No big real mystery when you understand market mechanics. It's kind of simple.
Uh-oh, accusing our listeners of libel, sir. I don't think he meant you, Jason. Don't worry. Isn't Max Payne? I always thought that was just a garbage movie with Mark Wahlberg. I never really gave much credence to the actual market theory.
I think the movie is actually more believable than the market theory part.
That's saying something right there, listeners. If you've ever seen that horrible movie, I think the game associated with it far better than that terrible movie. But yeah, that gets back into the whole screed too of, the anti-market maker screed. Market makers are some giant monolithic cabal, and they have this great market moving power. You and I both stood down there, Dan. I think there were many days where we wished we had some great market moving power, but certainly not really the case in real life.
I could have just moved the market in my direction one single time is all I would need. But yes. No, it doesn't work that way. You can't move the market to where you want it to.
Doesn't take much, and unfortunately, no, you don't even have that power. So yeah, all the people writing in, market makers are crooks, they're evil, they're stealing our money. There's some great cabal, some great conspiracy. It sounds nice. It may make you feel better at the end of the day, but unfortunately, or perhaps fortunately, depending on your point of view, simply is not the case. Great question, though, Jason. Good topic for us to really sink our teeth into a little bit. All right, another one coming up. Another good question. This comes from a listener, Alan Manning. He writes, "Hello, everyone." Well, hello, Alan. He goes on to write, "I just started listening to the Options Bootcamp podcast." Well, welcome to the show. He has a lot of archives for you to explore. Quite a bit for your listening pleasure there, Alan. All right. He continues, "I'm really enjoying it. I have a question about a strategy described in episode 20, options in lieu of stocks. As a covered call alternative, I was interested in possibly buying a leap with a 1 or 2 year expiration and selling monthly calls against it. When I looked up a few stocks and ran some preliminary numbers, I noticed that the cost to purchase a deep in the money leap, that's of course, listeners, a leap, L-E-A-P, long-term equity anticipation security," and Alan puts in parentheses here, about an 80 delta, so that's where he's thinking a decently in the money option. He says the cost was higher than the total money I would make selling those calls for the duration of the leap. What I did to get these rough numbers was to take the money earned from selling the initial 1 month call after commission costs and multiply it by 12 or 24. I'm assuming one or more of these possibilities. 1, the method I use to get these figures is wrong, even as a rough estimate. The strategy will only work with certain stocks or underlyings that have optimal Greek numbers. That was his second suggestion. Number 3, this method only works when assuming the underlying leap also appreciates in value to offset its own cost. And number 4, the commission costs to make this strategy less successful. And he writes in parentheses, I have a TD Ameritrade account. Any information you can provide about this strategy is greatly appreciated. Thank you. Keep up the good work on a great program. Alan from Las Vegas. Well, Alan, great question. A lot of people wonder about the same kind of thing, and you did some basic homework. I'm glad to see you're doing that, because that's what you should be doing before you enter into any options trade, and I'm glad to see that you've done some calculations. So let's first off, let's even dial it back from there. Let's think about why you're putting on a position like this, and this is a strategy we've advocated in the past. Typically, people will buy a stock, right, covered calls against it. We've said, hey, why don't you instead take that capital you're going to pay for the stock and put it towards buying a leap and then write the calls against it. You've essentially legged into this diagonal time spread type position, but it's much more effective. So first off, before we even get into your questions here, Alan, what are the benefits of doing that versus just doing it with stock? Because it sounds like you say, hey, I should just do the stock. Well, you're going to spend a lot more money to buy the stock. And remember, at the end of the day, stock at best is going to be margined on a 50% basis. And if it's a stock you're buying that's relatively pricey, that's going to get pretty expensive pretty quick. So you're putting away a lot of money and spending it on outlay to buy that stock. So that's not being factored into your calculation first off. By doing this strategy, it should be a much more efficient from a capital perspective. So now you have whatever percentage of your portfolio, 10, 20, maybe 30, maybe more, % that's free. That's an opportunity benefit now that you can have and take and invest in another strategy. So first off, that's a part of your analysis here that's missing, is what you're doing with that money that you're saving. It's not just a question of paying for your call, although that's nice. You have other benefits from this strategy as well. We've also said, Dan's the guy who wrote the book on the Greeks, and this is also a position that benefits you from a Greek's perspective versus doing it with stock. So now you have a delta, like you said, 80 delta. So now do the math. The underlying drops $1. That's part of the worst case scenario of a covered call position. You're only losing 80 cents as opposed to $1. So, and that delta will continue to decrease if the worst case comes to pass, the underlying continues to drop. So that delta is also going to be your friend. You're not going to lose as much to the downside. You also have a Vega component to this trade now that you don't have with a stock trade. So therefore that Vega is going to increase. Again, you're not going to make money to the downside, but you're going to slow your rate of loss, certainly much slower than if you owned the underlying. So these are all intangible benefits that you're not factoring in to your calculation. And then the other thing I would just say to you is, at the end of the day, the reason you're putting this position on usually is that you expect some sort of appreciation in the underlying. That's why you have the underlying component. And then you're writing the covered call to boost that, to add something to that. So in that scenario, of course, your numbers here don't factor in any sort of appreciation for the underlying, which would, at the end of the day, be the lion's share of the value of the trade. So at the end of the day, even if your suggestions are right, and again, you make a good point that you can't really assume that just by multiplying by 12 or 24, volatility is going to change. So you're never going to be able to write the same volatility level several months in a row, let alone 2 years in a row. So that estimate is going to fluctuate. And of course, other things are going to happen. The underlying is going to change. The skew is going to evolve over time. So those levels, those prices, those premium levels you're collecting are all going to change. But as a ballpark barometer, what you're doing isn't a terrible thing. I would just encourage you to keep in mind the intangible benefits and the tangible ones, like the capital efficiency, all of which make this strategy far more effective than just the simple math that you did here, which is just to offset one with the other. That's not the goal. Reducing the cost of that leap is great. You want to do that, and the options give you that benefit. So now you have a position that was cheaper to begin with, and now as a result of writing those options is even cheaper as a result. So that's a great benefit. You're putting more capital into your account that you can use for other trades. So there's a lot of intangibles here that you're not mentioning in your analysis. Mr. Passarelli, what's your take here for our friend Alan from Las Vegas?
I mean, basically, Mark, I think you said it great. I couldn't really add too much more useful information to that. I mean, you hit it on the head, I think.
Well, that's why they pay me the big bucks, sir. Great question, Alan. And it's a good bit of homework, a good exercise, I think, for anyone out there to do. But I just encourage you to remember, again, the goal of this is not just to balance one with the other. There's other benefits involved in using the options that aren't being taken into account with your analysis. So even if it all works out the way you said, there are still many other benefits coming in that are worthwhile using that position, that are certainly more beneficial than just buying the stock and then writing the calls against it that way. All right, next up, here's a good question from Ethan Kamen. This is something I don't think we've touched on that much on the show in the past, so it'll be a good one to sink our teeth into here, Dan. He writes, my question may be a little basic for the esteemed bootcamp drill instructors, but I would like to know about back spreads. It seems like the majority of the information online is devoted to ratio spreads. Is there a reason for this? Are back spreads not popular? Do you use them? If so, what scenarios are suitable for back spreads? Thanks for this show. I look forward to each new episode. Well, great question there, Ethan. Mr. Passarelli, why don't you do our friend Ethan the courtesy of doing an overview of back spreads and then perhaps their evil sibling, the ratio spread?
Mm-hmm. Well, it's kind of interesting. Like in different niches within the options business, like different words mean different things. And as a floor trader, as a market maker, the word back spread basically just simply meant I'm long gamma, like I'm not long options. In the life of a retail trader, which is basically everyone who's not a market maker or a proper professional, it pretty much means a ratioed spread where you're short in the money say, call and then long several out of the money calls, or the same thing with puts, short, in the money put, long several out of the money puts. So, I mean, as far as by retail trader standards, it is by definition a ratio trade. Professionals, again, not really. They look at things a little bit differently. So, I mean, that's probably why you get all that information about ratio trades, because by definition, a back spread is a ratio trade where you're long more options than short and therefore end up having a positive gamma situation. As far as the practicality of them and do I use them, I can't remember the last time I traded a back spread. And it's because they can be pretty tough to trade. Almost always, whatever your outlook on the underlying stock is, there's probably a better way to trade it. There's probably a way where you have a better risk reward or a better chance of success, or your maximum loss is more favorable or something. So I don't know. I mean, I'm not a super big fan of the retail-based, long ratio call spread, AKA the back spread. I'm not a super big fan. I just, one of the rules that I've talked about on the show, and I always tell my students, is whenever you're considering making a trade, always envision 3 different ways to trade that same forecast and pick the best one. And I bet if one of those 3 ways is a back spread, you're never going to pick it. I'll bet the other 2 ways are probably always better. So there.
You're right. I don't really tend to favor the back spread that often either. And you're right. It is an odd term. It's a term I never really encountered as a professional. I never heard anyone come up to me and say, hey, I'm putting on a back spread. It just wasn't a term we really used. It wasn't until, I left the market making realm and started interacting more with the retail audience that I started hearing this term bandied about a little bit. It kind of shows the fluid nature of options terminology and why it could be so confusing to the newcomer to the space, because sometimes people use the same term to mean different things, which is a problem for any product, any sort of endeavor where people are confusing each other. But you're right, retail tends to use it, and it is a ratio spread, you're right. But people, in my experience, when they're talking ratio spreads, they tend to be talking the other side of that coin, the coin where they collect as opposed to pay out. And that's typically where the ratio most people are familiar with as listeners. The one where let's say you're buying an at-the-money call, and then you're selling 2 or 3 out-of-the-money calls against it, again, to finance that outlay, either reduce it or eliminate it completely, or perhaps in the very, very aggressive ratios, collect a credit. You could see both the benefits and indeed the drawbacks to that instantly. There's a little bit of risk there if you start moving towards that short strike. So bear that in mind. That's why I say the evil twin. Ratios always have their uses. They're a great strategy. Just bear in mind, you can go a little overboard with them at times. And that's where a lot of people like to focus their trading, the minimum outlay type trades. The other types, these types of back spreads you're talking about, Dan, where you're buying more units than you're selling. Some people don't tend to view things like that very favorably. So bear that in mind. That's why ratio spreads, the typical version of the ratio spread, the net short units type, the 1x2, 1x3, is more popular than the short 1, buying 2, buying 3, because at the end of the day, people like to minimize their outlay and they can go crazy with that typical ratio spread. And again, your question, use case for it. Yeah, I don't really use it that much, but there are good use cases for it. If you're shorting an underlying you think is not going to have a lot of movement, but you're kind of worried perhaps, and maybe during the lifespan of that trade, there could be the proverbial black swan event that happens and the underlying could take an aggressive move, then if you're net long units, the underlying is going to move in that near term, you're going to lose money. But if that move continues, that net long units is actually going to kick in and you'll make money over the long term. So you'll be protected against that aggressive move and you can actually make money for it in the long term. Our good friend Nassim Talib, that's essentially how he trades. And a lot of people would think, oh, a guy like that, he's so worried about big black swan events. He coined the phrase, for God's sake, that he'd be nothing but long premium. And actually, that's not the case. He shorts a lot of at-the-money premium and then he gets net long units, typically to the downside, because that's where his concerns are. And he does back spreads. And so that's how he finances his black swan type positions, is he sells a lot of at-the-money premium against it. That's a simplification of it, but that's essentially the strategy there. So there are use cases for it. If you have a viewpoint like that, you can certainly adopt this strategy. So it's just not one that I typically utilize, and it sounds like you don't utilize it that often either, Mr. Passarelli.
Yeah.
Great question there, Ethan. Keep them coming. We like them. It's just not a strategy we use a lot, but certainly if you have a viewpoint like that where you think it's not going to move that much, but in case the worst does come to pass, you want to have some protection and actually maybe make some money, not a bad scenario for you. and not a bad strategy to implement the old back spread. I like to just think, hey, I like someone's thinking this way, being net long units. It's very good from a risk management perspective. Your broker will certainly appreciate it. And it's nice to have one letter that comes in this way as opposed to, how can I trade maximum ratio spreads to buy one short 50 or something crazy, which I'm sure a lot of your students ask you as well, Dan. How come if I can sell one, how come I can't sell 60?
Yeah, exactly right. Work still doesn't work, right?
Yeah, exactly. All right, last up here, we have a question from, I guess you pronounce this Lithian. I'm not sure. That's our listener handle here, and he or she writes, what is the ideal time horizon for trading options? My typical stock trade lifespan is 3 to 6 months. I've heard many people describe options as short-term investments. Is my time horizon too long to be trading options? Great question, Mr. or Mrs. Lithian. Mr. P, what do you have to say to our friend here?
Long-term and short-term are pretty darn relative terms, To my grandfather, short-term is 10 years, To the high-frequency trader, short-term is about 6 milliseconds. So it's all relative, man. The thing about options is they do sort of have a sweet spot in where they're most beneficial. Regardless of your time horizon on a stock trade or anything like that, I would say options are most useful when they have between 5 days and 5 weeks time until expiration. And that's because for option buyers, they're cheapest then in terms of just, the price tag of how much you pay for the option in terms of premium. So if you're protecting or speculating, they're cheap. Low risk in that regard as far as what my maximum potential loss is. And for option sellers who are grinding out theta, that's where the theta is highest in the shorter term options. So short-term options, meaning 1 week or 5 days to 5 weeks, that's really the sweet spot. And then if you have a 3-month time horizon, well, that's fine. Just, sell a 1 month call against it. I'm assuming you're doing covered calls, could be anything, but sell a 1 month call against it. And then when that one expires, sell another month and then sell another month. And there's your 3 months. So keep the individual option trades to 5 days to 5 weeks.
You're right. That's one nice thing about options, Dan, is that they're all things to all people. You can carve them up and change them up to suit your strategy. So if you want to go for 6 months or a year or whatever, you can do it. Or if you want to go much shorter, you can do that too. And you could do it with longer term contracts. You can do it with, as you advocated, shorter term ones and piecemeal them kind of together for the duration of the trade. Whatever floats your boat, you can do what our listener wrote in about here today. And if you want to do a longer term one, let's say 6 months, and you want to buy that protection for the full amount of that and then write nearer term calls, weeklies or monthlies to finance that, that's a way you can do it too. You can combine long and short in the same position. There's no hard and fast rules here in terms of what you have to do. It really is what's suited to your position, which is, again, why we like these products, why we think they're so useful, why we've devoted a whole show to explaining to you guys how you can best utilize them and implement them in your portfolio, because they are very suitable to just about any scenario you can think of in the marketplace. I know the disclaimer from the brokers and from the OCC is, options involve risk and may not be suitable for all investors. But I tend to dispute that. I think they are pretty much suitable for most people out there if you're using them correctly. They are, at the end of the day, risk mitigating tools, and anyone could use a lot more risk mitigation in their lives, I'm sure, and in their portfolio. So options are certainly useful in that scenario there. So great question, Mr. or Mrs. Lithian. And if you're curious about that, I'm sure you want to go back into our archives. We've outlined a myriad of strategies that you can use to implement that viewpoint, a variety of different ways. That strategy is outlined: nearer term verticals, mixes and matches, covered calls, protective puts, collars, all that fun stuff. We've outlined all of it there on the show. A lot of great listening for you to go and check out. A lot of great learning to do too in the archives of this program. And listeners, I would encourage you to go visit those if you're a new listener to the program, or you want to refresh yourself on a particular topic, something great to listen to while you're commuting to work or while you're working out or whatever the case may be. You actually learn something while you're doing those activities that are otherwise just wasted time. All right, Mr. Passarelli, that's going to do it for the old mail call, and that's also going to do it for this episode of Options Bootcamp. But before we go, as always, let me check in here, see what's cooking in the land of market taker that may interest our listeners. Mr. P, what's going on over there in the land of MTM?
Man, this summer I decided to take a little bit of time and revamp one of our classes, and it's been a big project for us. but it turned out really, really great. We have a class called the Income Trading Master Sessions. It's a 6-part series, all on income trading. 2/3 of the class is on adjusting. It's really, really great stuff, whether you're a beginner, intermediate, or advanced trader. It's a total of 6 videos that are an hour long, so it's a solid 6-hour class. And we just completed that class, and we're getting ready to launch that and make that available to our students. So if anybody has any questions about that, I imagine you can email me directly if you'd like, dan@markettaker.com, and I'll show you how you can take part in that class.
Segment on adjustments, that's probably worth it right there. That's really where the rubber meets the road for a lot of options traders. And we talk about establishing a lot of strategies here, but adjusting those strategies is also where a lot of the skill and expertise comes in. In fact, we have a whole episode about that here on the old bootcamp program as well, listeners. So if you haven't had a chance to check it out, surf on over to the archives available, iTunes, Stitcher, theoptionsinsider.com, in our mobile app, wherever you like to listen to the show, and check it out. I'm glad to see you have an episode on that, Dan. And to refresh our listeners, or I should say a class on that. We do the episodes, you do the classes. Just to refresh your memories, listeners, we do have Options Bootcamp 41 and 40, both of those episodes from February and March of this year, where we dive all into those adjustments, basic adjustments, and then advanced adjustments. So check those out if you want to learn more. Excellent stuff. And on behalf of Mr. Passarelli and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for sending in such great questions. Keep them coming. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.